how do the bank regulations impact your view of kind of the macro environment? And so what I'm referring to specifically like Basel III or SLR, because we talked about how, the Fed's balance sheet might not matter as much as people think it does. And when you go back prior to 2008, I don't think that's even debatable because they're basically, they're effectively zero reserves in the system when you look at how few there actually were compared to global dollar M2. But now, they say, okay, it's a different ball game here. We're in a excess or what do they call it? Something reserve environment, and we do have these regulations that may constrain the overall banks. So, can you give me your view on those regulations, if they are constraints, if they aren't, and then maybe we can kind of unpack what those regulations actually mean and try to put them in simple terms.
So we have to be careful to not think that the future will look like the past. And one other way of looking at this is we want to be careful not to be fighting the last war. So the last war in people in public policy, in financial market policy, was the 2008 great financial crisis. It was basically a banking crisis, right? So at the end of the day, a lot of banks, bought a whole lot of stuff that was not worth as much as they thought it was, and they were sitting on big losses. They were basically insolvent, and so there was a huge run on the financial sector. So that was really bad. And in response to that, the regulators, not just in the US, but throughout the world, passed a lot of regulations that really, really, really tightened up on banks a lot. In fact, for the biggest banks, the rules are really stringent and it's made them really boring or quasi socialized businesses. Now, it the rules basically put a whole bunch of constraints as to what a bank can invest in. I put a whole bunch of costs for a bank if it invests in things that are too risky or if it gets too big, and made sure that a bank did not have borrowed too much flighty money and so forth. And so at the end of the day, it really made the banking system much, much safer than before. And the way that you can see that it's worked is look at 2020. We had this huge, huge crash in the financial markets worldwide. But at the end of the day, the banking sector totally fine, right? Totally, totally fine. Equity market crashed, treasury market crashed, corporate debt crashed, and the banking system was totally okay. Now, because I realized this, and you can look at what's happening in, let's say, the regional banks, and you can know that it's going to affect some individual banks, but it's not going to be something that's systemic, simply because the whole regulatory structure has basically quasi-socialized it, made everything, you know, really boring. And I think it's something that happens to many industries actually once the government gets involved.
So it's made it safer in your view, but has it made it less efficient?
I think it's made it more difficult for it to perform its job.
That's
Let's
kind of
say
what I'm getting at.
that's its job, basically to make loans to people,
In the
and
real economy, so we can
in
produce
the
more
real
goods and
economy.
services.
But that's okay because where there's a will, there's a way. So banks, let's say they don't want to make as many loans, or maybe they make loans at higher interest rates because their own costs have gone up. So what
Mhm.
happens? You have all these other entities pop up to take their place. One of the big ones that we've been hearing a lot about is private credit. What's private credit? Private credit is just basically a whole bunch of rich people pool their money together and they make loans directly to businesses. So they are like a bank, but they are not regulated as a bank. And so these guys, they're growing tremendously. Now, let's look at something more close to home, mortgages. So banks don't really originate that many mortgages. Most mortgages are actually originated by non-bank lenders. Think Rocket Mortgage or something like that. These guys, they're not banks, but they make loans. And they're there eating the bank's lunch because they are regulated in a different way.
Okay. Yeah. So, and the thing, as you were saying that, the thing that was coming to my mind is I just read an article the other day about these buy now, pay later, I think. And this is kind of what all ironically enough, all the banks are lending to these shadow banks, if you want to call them that. And then they're going on and then piling all of this risk. on their balance sheet, and for some reason the banks think that doesn't impact them, right? But I guess this leads us to our last topic of the day, which is commercial real estate. What's your view on what's happening there and how that might impact the not just the regional banks, but if it increases risk within the system, that might not bring down a JP Morgan, but that might make them less willing to create more loans, which might see bank credit kind of flattening out, which could be a deflationary pressure.
Absolutely. If the banks have been significantly reducing the amount of loans they make. So if they have credit problems, they'll definitely reduce the amount of lending further. So when I think about commercial real estate, of course, as we all know, commercial real estate is an umbrella term that covers many different assets with many different supply and demand dynamics. You have multifamily, you have, let's say, hospital, you have industrial space, you have data centers, and of course, you have stuff like office space. So these sectors, broadly speaking, they're doing well, but there are a few that are doing very poorly. And as we all know, downtown office space is doing very poorly. The reason for this is just because of structural changes in how the economy works. We have work from home now, and so people don't like to go back to the office. And so all this expensive office space that was counting on, let's say, companies continuing to work there, employees continuing to come into the office, that many actually perceived to be a safe investment, actually, basically overnight, turned out to be worth a lot less than before, simply
Or worth
because,
less.
yeah, well, worth less.
Worth less or worthless.
Especially in San Francisco, right?
Right, right.
So, so it's a it. I don't think it has anything to do with like let's say regulation or anything like that. It just has to do with a change in the culture, and stuff like that happens, right? Sometimes it's like the invention of the printing press or invention or something like that. You have these big changes in the world, or invention of the car. You don't need horseshoes anymore, right? You have cars now. So you have these big structural changes, and sometimes people get caught offside.
Hmm.
Now, the important thing is, how is that risk distributed in the banking system? Is it really concentrated? Is it diffuse? Or how is it doing? So one thing I note is that it's really not what you. So if you know a risk is there and you prepare for it, then it's much less likely for it to be severe. Now we've known that there are these commercial real estate problems for a year now. So I think a lot of people have had time to find out a way to work it out. So it's not a surprise anymore. So I think that's a big advantage going forward. Now, according to banking data that I've seen, now overall, the amount of uh, let's say potential bad assets and is not large in the big banks. It's not large in the medium-sized banks, but it seems to be largely held in the very small banks that basically no one has ever heard of. So we have about 4,000 banks in the U.S. And so among those 4,000, I'm sure most people have not heard of 95% of them. And so some of those banks are going to have concentrated portfolios potentially in these sensitive assets. And so they're not going to do well. But I think it's very much going to be an individual story.
I'm sorry to cut you off there, but what do you think about the BTFP expiring? That shocked me the other day. I could not believe that the Fed did that. And
Well,
I
they
don't know
had
if
a
they're trying to push people to the discount window or there's some sort of PR play, but I just thought of that, and I just wanted to say that really quick so I didn't forget.
So the BTFP is expiring. So that announcement actually had two things in it. One is that it's going to expire in March as uh, okay. It was initially a one-year facility, so people weren't sure if they were going to renew. So it was going to expire as originally scheduled. It could have been renewed, but it wasn't. And the second thing is that they raised the interest rate on those loans to not less than interest on reserves.
Right.
So that tells me that part of the reason why they're not renewing it is that it was perceived to be basically a giveaway to banks. I think there was some articles about that in in the legacy media outlets. So basically,
Just
uh,
bad optics.
the interest rate that was on those loans was a lot less than the banks could receive on reserves. So in a sense, the banks were literally being paid to borrow from that facility. Now, I don't think the Fed wants to be perceived to be just giving free money to banks, right? And so I think that that kind of uh, encouraged them to not renew the facility. There was enormous amount of participation heading up, I'd say the past few months, and I think lastly it was about 160 billion dollars.
Yep.
So if you're the Fed, you don't really know if people are borrowing because they're in serious trouble or it's because the Fed is basically paying you to borrow. I'm guessing that they were getting the sense that more people were participating simply because the rate was so advantageous, and so they just kind of turned that thing off.
And do you think from
Now,
their
you raised
standpoint, they're thinking, okay, and if we were wrong, then we can just go ahead and flip the switch and turn it back on again?
They could, but there's something else that's going on as well. So
Okay.
there's another article in Bloomberg where banking regulators, not just the Fed, but the FDIC uh, and the OCC, they want to force all banks to tap the discount window once a
Yeah.
year. What
Yeah.
they want to do is they want to normalize the discount window. So in a sense, you can think of okay, so they're trying to like people think of the discount window as a BTFP that you can tap anytime. Of course, the rate is not as good, but you can tap it anytime you want. So it's a way to normalize banks to just borrow from the Fed through the discount window. And if you have that, if you have the discount window and you will have a culture that people are willing to use it, then you really don't have to worry about liquidity for banks.
But they're not getting 100 cents on the dollar.
I know, right?
That's a big deal, right?
You know what? So they were not getting 100 cents on the dollar so they're not being able to borrow equal to par of the asset. But there's something else as well. The discount window can accept a wide range of collateral. So
Okay.
even if you have a corporate loan or just whatever mortgage, you can pledge it to the discount window. It's actually uh, you can pledge basically almost anything there. It's much more accessible in that sense compared to
Okay, so
the
they're thinking that
BTFP.
that'll balance it out, the fact that they're not able to get 100 cents on the dollar.
So I that special thing of the BTFP is highly unusual. So it's really more in line with, let's say, historical practice to be able to borrow against the market value of the collateral rather than the par value.
Yeah, yeah. I'm trying to put myself in the position of a Fed official or Powell saying, "Okay, well, I'm gonna turn off this BTFP. I don't know if this is really bailing out banks right now, if this is going to create additional risk, or if they're just using it as an arbitrage. But just in case they're really at risk, well, then I'm going to try to destigmatize the discount window. And even though they're not getting 100 cents on the dollar, hopefully it'll be the same type of bailout because they're just able to use a lot more of the assets that are on their balance sheet. So even if they're not getting 100 cents on the dollar, it still basically saves them."
Um, so let's say that you're a bank with $100 balance sheet and you need some extra liquidity, right? So maybe you need an extra $5. Then in theory, you should have $100 of assets you could pledge to borrow to make that $5 deficit. I think it should be more than enough.
Yeah. Okay.